52.63 million ounces. That is the number of silver ounces that traders stood up and demanded for physical delivery on February 27, 2026, a single day. Now compare that to COMEX's registered immediately deliverable silver supply at the time, 86 million ounces, in one day. More than 60% of the entire physical delivery pool was suddenly claimed. And right in the middle of all of this, CME Group did something that sent shockwaves through every leveraged silver position in the market. They raised margin requirements to 18%. Effective immediately after the market closed that Friday. If you think that's just a dry technical footnote for professional traders, I need you to stay right here, because what I'm about to show you is a pattern so clearly documented, so perfectly repeated across history, that once you see it, you cannot unsee it. This is not speculation. The numbers I'm going to walk you through today come directly from CME Group's own filings, Reuters reporting, and official COMEX warehouse data. And by the end of this video, you'll understand exactly what happened, exactly what this margin hike means for the silver market right now in March 2026, and exactly what it has meant every single time this has happened before. Every single time. Let me give you the context first, because this story doesn't start on February 6, 2026, when CME announced the 18% margin hike. It starts about 14 months earlier. In January 2025, silver was sitting around $30 an ounce. Not exciting, not alarming, just $30. More or less where it had been bouncing for a couple of years. Then something changed. Slowly at first, then faster, then completely off the charts. By late January 2026, silver had hit a nominal all-time record high of $121.67 per ounce. I want you to let that sink in. From $30 to $121 in roughly 12 months. That is a 300% gain in a year. That's not a bull market, that's a parabola. And parabolas in commodity markets have a very specific and very predictable ending. The question is, are you positioned correctly when it arrives? Now the CME, the Chicago Mercantile Exchange, the world's largest derivatives exchange, the organization that effectively controls how silver is priced globally, they've been watching this with great concern. And when they get concerned, they have a very specific tool they reach for. On January 13, 2026, CME did something quietly structural. They changed how they calculate silver margin requirements. Before that date, margins were based on fixed dollar amounts per contract. After January 13th, they switched to a percentage of contract value system. That might sound boring, but here's what it actually means. In a rising market, your margin requirement automatically scales upward with every dollar the price climbs. You don't even need them to make a new announcement. The system tightens by itself. Then, having put that mechanism in place, CME raised margins on January 30th, then again on February 2nd. Then, for the third time in less than 2 weeks, on February 6th, they announced that COMEX 5,000 silver futures margins were being hiked to 18% from 15%. That's a 20% increase in collateral requirements in less than 2 weeks. Reuters confirmed this on February 6th. It took effect after market close that Friday. Stick with me here because this is where it gets genuinely interesting. I need to show you something before we go further. A framework that puts all of this in context. Because here's what very few people are talking about. This is the third time in modern history that CME has used this exact same tool, margin hikes, to cool down a runaway silver market. And the pattern of what happens next is almost identical each time. Let me show you. Quick message for the people watching who haven't subscribed yet. My analytics show that roughly 3 out of every 4 people watching right now are not subscribed. If this kind of analysis sourced directly from official filings, no hype, no guessing is cutting through the noise for you, hit subscribe. That's how I know who the committed audience is, and it helps the algorithm get this in front of more people who need to see it. Okay, back to the history, because this is critical. Episode 1, 1979 to 1980. You may have heard of the Hunt brothers. Nelson, Lamar, and William Hunt, Texas oil billionaires, started accumulating silver in the early 1970s when you could buy it for about $1.50 an ounce. By 1979, they were holding an estimated 100 million troy ounces. Some reports put it as high as 200 million ounces, representing roughly 1/3 of the entire world's tradable silver supply that wasn't held by governments. Their buying drove silver from around $6 an ounce in January 1979 to a peak of $49.45 on January 18, 1980. That's a 713% gain in 12 months. The futures market hit an intraday high of $50.35 on that same day. Then, on January 7, 1980, 11 days before the peak, COMEX introduced Silver Rule 7. It placed heavy restrictions on margin-based silver purchases. Traders wanting to buy more silver suddenly had to post nearly 100% cash. No more leverage. Then Fed Chairman Paul Volcker raised interest rates from 11.75% to 20%. Silver dropped from $49 to $10 per ounce by the end of March, a collapse of nearly 80% in 10 weeks. On March 27, 1980, what became known as Silver Thursday prices dropped 50% in a single day. The Hunts couldn't meet a $100 million margin call. The ripple effects threatened to collapse multiple banks and brokerage firms. The Hunts ultimately declared bankruptcy and were ordered to pay $134 million in damages. Episode 2. 2008 to 2011. After the financial crisis, the Federal Reserve launched its zero interest rate policy and quantitative easing programs. Money flooded into silver as a hedge. Silver climbed from about $8.50 per ounce in late 2008 to $48.70 in April 2011, another 500% run in roughly 2.5 years. And then CME started hiking margins. Not once, not twice, 5 separate times in 9 days. According to documented reporting, those 5 hikes effectively doubled the cost of holding silver futures positions. Silver fell nearly 30% within weeks, then spent the next 4 years in a protracted bear market, eventually bottoming around $14 in 2015. 5 margin hikes in 9 days. Think about that. And now Episode 3. January 2025 to February 2026. Silver rises from $30 to $121.67, a historic nominal all-time high. CME changes its margin methodology on January 13, 2026, then hikes margins 3 times in less than 2 weeks, culminating in the 18% rate announced February 6th. Silver crashes from the 121 peak to the low 70s. As of right now, March 14, 2026, silver is trading around $84 to $85 an ounce, having bounced off those crash lows but still sitting nearly 30% below the January high. Same playbook, 3 different decades. The CME's own documented actions, reported by Reuters each time, show that margin hikes have been the tool of choice for cooling overheated silver markets without exception. Now here's where it gets interesting. And I mean genuinely, statistically, mathematically interesting. Because the story doesn't end at the margin hike. What happened next after the 1980 crash and after the 2011 crash is the part nobody talks about. After Silver Thursday in 1980, silver didn't just stabilize. It collapsed to $4.90 by 1982 in London fixed prices, a 90% decline from the peak. And it didn't recover to anywhere near those levels for nearly 3 decades. After the 2011 crash, silver spent 6 years in a bear market. But here's the other side of that coin, and it's equally important to understand. In both cases, the long-term fundamental demand for silver never vanished. Industrial demand, monetary demand. After each crash, the market eventually found its footing and rebuilt. The question is always, where are you when the rebuilding happens? Let me now break down the current physical market data, because this is where the 2026 situation starts to look genuinely different from both 1980 and 2011. And I'm not asking you to take my word for it. Every number I'm about to give you is directly from CME Group's own warehouse reports and official delivery data. COMEX registered silver, that's the silver that's actually sitting in approved vaults, fully warranted and immediately available for delivery against futures contracts, has been collapsing. In October 2025, COMEX had approximately 167 million ounces in registered inventory. By early February 2026, that had fallen to 103 million ounces. By late February, around 86 million ounces. That's a decline of nearly 64% from the October 2025 level over just 4 months. According to analysis published on the Metal Charts COMEX tracker in early March 2026, the drainage rate was running at approximately 785,000 ounces per day at its peak. The site's own stress index, which combines coverage ratio, inventory trend, paper leverage, and vault outflows, was showing the coverage ratio at 13.6%, firmly in what they classify as stress territory. Now here's the number that really stops you in your tracks. Paper leverage on COMEX silver, meaning the ratio of outstanding paper futures claims to actual deliverable physical metal in the vault, was sitting at 7.4 times. 7.4 paper ounces claimed for every 1 real ounce sitting in the registered vault. In a normal, healthy, functioning futures market, that number tends to be much higher because most traders never want delivery. They're speculating on price direction and roll their contracts forward. The system works because most people are just trading paper. But what happens when they stop doing that? What happens when the people holding those paper contracts suddenly want the real thing? Look at the delivery data. In February 2026, traditionally a light delivery month in the silver market, historically running somewhere between 3 and 5 million ounces, CME's own delivery report shows that 5,036 contracts were delivered. That's 25.18 million ounces, between 5 and 8 times historical norms for February. A paper I found on Substack by a researcher tracking CME delivery data specifically noted that on January 29th, first notice day for the February contract, 1,881 contracts were delivered in a single day. That's 9.4 million ounces in 24 hours. Institutional users weren't rolling their contracts forward. They were pulling the physical metal. And when February ended and March began on February 27, 2026, which was first notice day for the March contract, 10,526 contracts stood for delivery. That's 52.63 million ounces of silver demand, hitting a registered inventory of 86 million ounces on the first day of the delivery period, in one of the supposedly slow weeks of the year, against a vault that's already been drained 64% from its October levels. But it gets more interesting. Let me show you something about what's happening simultaneously on the other side of the planet, because this is the part that makes the paper versus physical divergence absolutely undeniable. Shanghai. The Shanghai Futures Exchange is China's primary silver futures venue, and the Shanghai Gold Exchange handles physical allocation. Throughout early 2026, traders noticed something unusual. Shanghai silver was trading at a consistent premium to COMEX silver, $3 to $5 per ounce above New York prices at various points. Now, in a normal, efficient global market, that kind of premium gets arbitraged away almost immediately. Someone buys cheap silver in New York and ships it to Shanghai to capture the price difference. The premium disappears. But when the premium persists, when it doesn't get arbitraged away despite every financial incentive to do so, it means one thing. The physical metal isn't available to move. The arbitrage can't happen because there isn't enough real silver in the Western vault system to send eastward. According to the Trading Key analysis published in January 2026, Shanghai Gold Exchange inventory had already fallen to 318.5 metric tons by February 2026, down from 559 tons in November 2025, a 43% decline. Both the Eastern and Western physical inventories were falling simultaneously. Now let me ask you something, and I want you to think about this carefully. The paper price of silver, as set by COMEX futures trading, crashed from $121 to the low 70s in the wake of the margin hikes. That's what the screen was telling you. The futures contract, the electronic number, the paper price down 30 to 40%. Meanwhile, the physical vaults were draining at nearly 800,000 ounces a day. Physical delivery demand was running 5 to 8 times historical norms. Asian premiums were persisting despite every incentive for arbitrage. Someone was not telling the truth. The paper market and the physical market were narrating two completely different stories. When that happens, when the price of something is falling while the actual stuff is disappearing from shelves at some point, the physical reality wins. It always does. The question is the timing. Now let me be very clear about something, because I want to be responsible here. This isn't a new phenomenon, and it isn't necessarily evidence of anything sinister on its own. Futures markets are designed to allow speculative positioning that can move prices independently of immediate physical supply. That's a feature, not a bug, in normal market conditions. Margin hikes are a legitimate exchange risk management tool. The CME is transparent about its methodology. You can verify their margin tables directly at cmegroup.com. But the convergence of three simultaneous signals, aggressive margin hikes, physical vault drainage at record rates, and persistent cross-market premiums is worth taking seriously as a signal about where pressure points exist in the system. That's not conspiracy, that's documented market mechanics. Here's something else worth understanding. When CME shifted to percentage-based margin calculations on January 13, 2026, they fundamentally changed the rules of the game mid-rally. Under the old fixed dollar system, if silver was at $30, the margin might be $2,000 per 5,000-ounce contract. You could model that. You could plan around it. Under the new percentage system, when silver is at $100, your margin on that same contract is now $5,000. When silver is at $120, it's $6,000. Every price move upward automatically makes holding a leveraged position more expensive. Reuters documented that from January 13th through February 6th, CME hiked margins under this new framework 3 separate times: January 30th, February 2nd, and February 6th. What that meant practically: Traders who were long silver futures in early January 2026 faced not just one margin call, but a cascading series of them, each one larger than the last because the percentage was being applied to a higher price. Imagine trying to hold your footing on a treadmill that keeps accelerating. At some point, you can't keep up. You sell. Everyone who can't meet the call sells. And that selling, piled on top of other selling, creates the crash. The Seeking Alpha analysis from January 5, 2026, before the full magnitude of the February hike was even known, noted that silver had already experienced a 17% price drop on the first margin hike of that cycle, with a 30% increase in required margins, triggering forced liquidations. By the time the three-hike sequence completed on February 6th, the total damage to leveraged longs was far worse. So let me now make this personal. Because whether you're a futures trader, an ETF investor, a physical stacker, or just someone trying to understand what's happening to precious metals, the implications are different for each of you, and I want to be specific. If you're holding futures positions right now on the paper side of the silver market, understand what the 18% maintenance margin means in practical terms. On a COMEX 5,000-ounce silver contract with silver at roughly $84, you're looking at a total contract value around $420,000. 18% margin means you need approximately $75,600 in capital posted to maintain that position. That's not a small number for retail traders. And critically, remember the percentage-based methodology. If silver moves back toward the $100 level, your margin requirement scales automatically to roughly $90,000 per contract without any new announcement. If it goes back toward the highs, higher still. This is a system that mechanically squeezes leveraged longs even when no new policy is announced. That's different from how the market worked before January 13th. If you're in silver ETFs, SLV, PSLV, and similar vehicles, understand the nuance here. ETFs track the paper price, which is set by the futures market. When margin-driven liquidations hit the paper market, the ETF price follows the paper price down, even if physical demand is rising. As analysts at goldsilver.com noted in their post-hike analysis, the CME margin mechanics affect futures traders directly, and physical holders not at all. But ETF holders are caught in the middle. They own paper backed by physical, but they see paper market pricing in the short term. For long-term investors, this distinction matters less. For anyone with a short-term horizon or a leveraged ETF position, it matters enormously. If you own physical silver coins, bars, allocated metal, the mechanism I've described literally does not touch you. No margin calls, no forced liquidation. The 1980 and 2011 margin crash episodes both showed that physical demand didn't collapse during the paper price crashes. In fact, physical premiums expanded significantly as dealers saw buyers step in to take advantage of lower prices. That behavior appears to be repeating right now in 2026, with physical delivery on COMEX running 5 to 8 times normal February levels, even as the paper price declined. Let me give you 5 specific things to watch as this plays out, because the situation is still developing in real time as of March 2026. First, watch the COMEX registered inventory daily. You can track this directly at CME Group's warehouse reports, which are published every trading day. The critical threshold being watched right now is whether registered inventory stabilizes above the 86 million ounce level, or whether the drain continues accelerating into the May contract delivery period. If it keeps falling, the pressure on each successive delivery month compounds. Analysts who have been tracking this specifically flagged May as the next key stress test if March deliveries run at anything near the demand levels signaled on first notice day. Second, watch for any additional margin changes from CME. 3 hikes in under 2 weeks was the pattern in February. After the 2011 episode, 5 hikes in 9 days, the silver market took years to recover. Whether we see additional hikes from the current 18% level, or whether CME holds here, will be an enormous signal about the exchange's assessment of systemic risk in the futures market. Third, watch the Shanghai COMEX spread. When Asian physical premiums compress back to zero, it signals that physical supply has found equilibrium. When they persist or widen, it signals continued physical tightness. Right now, with silver at around $84 to $85 in New York and elevated Eastern demand, the spread remains a live indicator. Fourth, watch open interest into the May contract delivery period. Open interest on COMEX Silver's May contracts represents the next wave of potential delivery demand. Analysts tracking this in early March noted that if even a fraction of May open interest converts to physical delivery at the rates seen in February and March, the registered inventory math becomes extremely tight. Fifth, and this one's for the bigger picture, watch Federal Reserve policy signaling. In 1980, Paul Volcker's rate hikes were the second arrow, alongside the margin hike that killed the silver rally definitively. In 2011, the end of QE2 provided the macro backdrop for the margin hike crash to stick. Right now, in March 2026, Fed policy is still a wild card. Any signal of meaningful rate increases would compound the effect of the margin hikes. Any signal of cuts or easing would provide fundamental support for precious metals. That policy backdrop is the difference between a temporary correction and a structural bear market. I want to be clear about something important. None of this is financial advice. I'm not a licensed financial advisor, and nothing in this video should be taken as a recommendation to buy, sell, or hold any specific investment. Silver markets are volatile. You've seen a $121 high and a $70 crash inside of about 2 weeks in this cycle alone. That is not a market for the faint of heart or for money you cannot afford to lose. The historical patterns I've shown you are real and documented, but past performance does not determine future outcomes. Do your own research. Consult a qualified financial professional for decisions that affect your personal financial situation. What I'm trying to do here is give you the framework to understand what you're looking at. Let me bring this full circle. We started with 52.63 million ounces, the historic demand for physical silver delivery on a single first notice day in late February 2026. We walked through the documented reality of COMEX registered silver being drained by 64% from its October 2025 peak. We looked at the paper leverage ratio sitting at 7.4 to 1, 7 paper claims for every deliverable ounce. We traced 3 specific historical episodes where CME used margin hikes as its primary tool for cooling an overheated silver market, 1980, 2011, and now 2026. And in each case, the short-term outcome was the same: forced liquidations, cascading selling, and sharp price declines that had nothing to do with the underlying demand for actual silver. The paper market reacted violently each time. The physical market kept draining. Buyers of real metal stepped in. Here's what the history tells us about what comes next, and I want to say this carefully. In 1980, the post-crash bear market lasted years. In 2011, silver spent from 2011 to 2016 in a long, grinding decline. Both times the margin hike worked. It did cool the speculative froth. Both times the fundamental demand story for silver was not destroyed, only delayed. Industrial applications kept growing. Monetary interest returned. In both cases, investors who understood the difference between a paper price shock and a fundamental demand shift, and who positioned themselves accordingly, were the ones who eventually benefited from the next cycle. I am not telling you this cycle will be different from 1980 or 2011. I am showing you that the mechanism is identical, the documentation is public, and the physical market data is sending signals that deserve careful attention. What makes 2026 structurally different from the prior 2 episodes, if anything, is the nature of demand. The solar industry, electric vehicles, and artificial intelligence data center infrastructure are all consuming silver at rates that didn't exist in 1980 or 2011. The Silver Institute and various industry analysts have been flagging multi-year supply deficits driven by industrial consumption growth. Those fundamentals don't change because a futures exchange raises its margin rate. They're slow-moving, structural, and they don't show up on a daily price chart. But they accumulate, and at some point, the physical reality of where all the registered silver has gone becomes impossible to paper over with a derivatives mechanism. Whether that convergence is months or years away is genuinely uncertain. But the data showing the direction of travel is not uncertain. It's in the daily warehouse reports on CME Group's own website. Drop a comment below and tell me this. Are you currently watching the COMEX registered inventory numbers? And what threshold do you think triggers the next significant move? I read every comment. Your perspective, whether you're a trader, a stacker, or someone brand new to this, genuinely shapes what I dig into next. The most interesting insights I've seen on this topic have come directly from the comment section of this channel. And if you want to go deeper on this right now, the next video in the series covers the gold to silver ratio at its current level of roughly 60 to 1, what that's meant historically, what it's signaling now, and why the institutions that have been quietly repositioning since October 2025 may be the most important story nobody's talking about. That video is right there. I'll see you in it.